How you doing? Jamie Johnson here, and welcome to this NoBSForexTrading.com Traders World Online Expo presentation. Before I jump into the webinar, I'm going to give you a brief history of myself while we go over the inevitable disclaimer that pretty much says take responsibility for your own actions. Once again, I'm Jamie Johnson. I'm the president of NoBSForexTrading.com. I learned my trading style and analysis from Robert Miner, the president of DynamicTraders.com. I worked with Robert for many years and I still work with him. I co-author his Dynamic Traders Futures Report, and I co-author his Dynamic Traders Stock and ETF Report. And I used to co-author his Dynamic Traders Forex Report. Since I am mainly a Forex trader, those are the main markets I trade, and Bob is mainly a futures trader, I branched out from Dynamic Traders and I started NoBSForexTrading.com. I have a couple of services with NoBSForexTrading.com. I have a daily report that comes out Mondays through Thursdays and Fridays. Monday through Thursdays and Saturdays. And I also have a 100% video report that comes out Wednesdays and Saturdays called the NoBS Forex Trading Net Trend Video Report. I pretty much go over the markets, the market position of the markets that I trade on a daily basis, which is the euro, the British pound, the Australian dollar, US dollar cross, Canadian dollar, Swiss franc, New Zealand dollar, and the British pound, Japanese yen cross. And I'm just pretty much giving the analysis that I use trading on a daily basis. So before we get to the webinar here, let's go ahead and see what we're going to talk about during this webinar. So I'm just going to briefly go over this list of what we're going to talk about today, but of course later in the webinar I'm going to go into each aspect in more detail. What I like to do in these webinars is I like to give a brief lesson of an aspect that I use in my trading, my trade strategies on a daily basis. And then the second thing I like to do is go over the current market position of at least one Forex market. Today we'll take a look at the Euro US dollar cross. Its current market position right now as I'm doing the webinar. Very likely when you watch the webinar it will not be current, but the positive aspect about this is you'll see if my analysis turns out or not, kind of a trial by fire. But what I'm going to first talk about today is capital exposure versus probability. When lower capital exposure trades usually have lower risk, but the probability of the trade being successful is usually less than a higher capital exposure trade. And I'll demonstrate this. And in order to give examples of capital exposure versus probability, I'm going to briefly discuss trading the end of corrections, because this is the trade strategy I use most of the time. So that's enough said here. Let's just jump into trading the end of corrections and capital exposure versus probability. So let's take a look at this British pound Japanese yen cross 60-minute chart. And as you can see, this market's been in a bull trend from the May 11th low. And if you check out this rally from the May 11th low to the May 11th high, it unfolded in a non-overlapping wave pattern. This is characteristic of a trend or an impulsive wave. And impulsive waves usually unfold in the direction of the higher degree trend, meaning the higher degree trend of the 240-minute time frame is also probably bullish. Then you see the decline off the May 11th high with a sideways to down pattern, overlapping wave pattern. This is characteristic of a correction or a counter trend. And counter trends usually unfold in the opposite direction of the higher degree time frame trend. So my main trade setup that I look at personally is to get in a trade at or near the end of a correction in the opposite direction of the correction, because that should put me in a trade in the direction of the higher degree time frame trend. So I'd be looking at bullish positions at or near the end of corrections in this market. Let's now take a look at the rally from the May 12th low to the May 12th high, also unfolding in a non-overlapping wave pattern compared to the decline off the May 12th high, which is a sideways to down overlapping pattern. May 12th to low to May 12th high rally is probably an impulsive wave, and the decline off the May 12th high is probably corrective. So there's a strong possibility that this May 12th high will be exceeded before the May 12th low is taken out. And a decline below the May 12th swing low would be the initial signal that this bull trend for the past couple of days has now turned bearish. Like I said, I like to get into a trade at or near the end of a correction. In this case, potentially at the end of the correction off the May 12th high, to get into a long position for a probable rally to above the May 12th high. That's the basis of this trade strategy of trading the end of a correction. But the tricky part is finding out when a correction is at or near completion. And that's when we use a dual time frame momentum trade strategy. So here are the basic guidelines for a dual time frame entry strategy. Use an oscillator with a setting that correlates well with the swing highs and lows of the market and time frame you are looking at. My favorite oscillators are the DT oscillator, which is a proprietary oscillator to the Dynamic Trader software, and that's the charting software we've been using here in this webinar. I also like the slow stochastic and the stochastic RSI. You can use any oscillator of your choosing, but these are my three favorites, personal favorites. Only trade in the direction of the high degree time frame oscillator direction. For example, if the 240-minute oscillator is oversold or bullish, only consider long trade setups in the 60-minute time frame. The 60-minute time frame being the low degree time frame. In the trade entry time frame, in the British pound Japanese yen cross example we are looking at, the trade entry time frame is the 60-minute chart and the high degree time frame is the 240-minute chart. If you enter trades in the 240-minute chart, the high degree time frame is the daily chart. So, in the trade entry time frame, also use an oscillator to help determine the end of the correction. So if the high degree time frame oscillator is oversold or bullish, only take long trade setups when the trade entry time frame is oversold or bullish. I know this is a lot of information, seems confusing, but we will straighten it out when we go back to our British pound Japanese yen cross example. So back to the British pound Japanese yen cross example. This is a 60-minute chart. And this oscillator on the bottom is the DT oscillator, the proprietary oscillator of this DT software. But if you don't use this software, which you probably don't, you can use a stochastic RSI or the slow stochastic, which is the top oscillator here. Any charting software should have the slow stochastic or the stochastic RSI. And I'm just using this oscillator setting that correlates relatively well with these minor swings here of the British pound Japanese yen cross 60-minute chart. So one of the guidelines is if we're going to enter a long trade in the 60-minute chart, the high degree time frame 240-minute oscillator must be bear oversold or bullish. So look at this low here, the May 13th low at 187.55. If we go up to the 240-minute chart, 187.55, May 13th. This oscillator setting here correlates well with the longer term swings of this of the British pound Japanese yen cross in this 240-minute time frame, and the 240-minute oscillator is bear oversold. Long positions may be considered in the low degree time frame 60-minute chart. Going back down to the 60-minute chart, then we have the 60-minute oscillators here also bullish. So there's a strong possibility that a corrective low off the May 12th high is at or near completion. And if this is the case, then there should be a rally to above the May 12th high, confirming the corrective low. So we have the 240-minute oscillator bear oversold, 60-minute oscillator is bullish. Long positions may be considered right now in the 60-minute chart for a potential corrective low. But before we jump into that, let's now talk about capital exposure versus probability. Capital exposure versus probability. Let's first define capital exposure. It's the value between entry and stop loss. Trading Forex, it's the pit value between the entry price and the stop loss price. And when you have the pit value, then you can translate it into a monetary value. In other words, capital exposure is the risk of the trade. The lower the capital exposure, usually the lower probability the trade will be successful. The higher the capital exposure, usually the higher probability the trade will be successful. And the reason for this is when you have a higher capital exposure, that means you're giving the trade a little bit more room to work through market noise. Let's check out the British pound Japanese yen cross example once again, and this will become clearer. So if you recall, it's a go. Everything's ready for a long trade setup here in the British pound Japanese yen cross 60-minute chart for a potential rally to above the May 12 high, taking advantage of a potential corrective low. So there's a couple of logical places I put up to enter a long trade setup. You can go long pretty much right away if this outside 60-minute bar high is exceeded. Shown by the horizontal green line. Then we have a minor swing high here also shown by the horizontal blue line, which is also a good entry. As you can tell, if you enter above the horizontal green line, you have greater profit potential, but it's probably a more solid trade if a minor swing high is taken out, which is the initial signal a corrective low is complete. Then there's a couple of places, logical places to place your protective stop loss. If a long trade is triggered, you can place your protective stop loss below the horizontal red line, which would be the potential corrective low. Or you could put it below the horizontal black line, which is the May 12th low. Because if a corrective decline is unfolding to the May 12th rally, the only thing that voids this corrective decline to the May 12th rally is a decline below the May 12th low. And if you recall, I also said that a decline below this May 12th swing low would be the initial signal this bull trend has now turned bearish. So this is another place you can place your protective sell stop. So there are 4 potential trade setups here in the British pound Japanese yen cross. These trade setups are now here on the chart, and they're listed from lower capital exposure to higher capital exposure. The first trade setup is entering above the green line, placing your protective sell stop below the red line. Lowest capital exposure, but also lowest probability because it's not giving the market much room for market noise. Because even if it stopped out, that does not void a corrective decline off the May 12th high. The second one is entering on the blue line, then placing your protective sell stop below the red line. The next one is entering on the green line and placing your protective sell stop below the black line. And then the highest probability but highest capital exposure, higher risk, is entering above the blue line and placing your protective sell stop below the black line. Let's go ahead and add bars and see what happened. Trade entered there, trade entered there, and then we had a rally above the May 12th high confirming the corrective low. So regardless of what trade strategy you would have taken, this was a successful trade. So since all 4 of these trade setups worked, you're probably saying to yourself, why would I take the higher risk trade? Why not just stick to a lower capital exposure trade setup, lower risk? Well, this doesn't always occur this way. Let's check out another example. Let's check out this US dollar Swiss franc cross 60-minute chart. We have a rally from the May 14th low to the May 14th high here with impulsive characteristics, followed by a decline with kind of a sideways to down pattern, more characteristic of a correction. The higher degree time frame oscillator is oversold, and I'm looking for what we call a trailing one bar high entry strategy. So when the 60-minute oscillator makes a bullish reversal, you put a stop to go long on a trailing one bar entry strategy. You put it above the last completed 60-minute bar. If that is not triggered, then you put it above the high of the next completed 60-minute bar, so it's trailed until it's entered. So we had a 60-minute DT oscillator bullish reversal, also a 60-minute slow stochastic bullish reversal. So I place a stop to go long above the last completed bar, above 0.9127, the horizontal green line. If a long trade is triggered, there's two logical places to place your stop, your protective sell stop. Below the red line, which is the potential corrective low, or below the blue line, which is the price if taken out. It's the only place that voids a corrective decline off this March 14th high, or off the 0.9169 swing high. So let's go ahead and see if the long trade is triggered, and it is triggered. So two places to place the stop. If I add some bars, if you place a protective sell stop in the below the horizontal red line, it would have been stopped out for a loss. If you place it below the blue line, you still would be in the trade. And then following the next 60-minute bar, the May 14th high, or this 0.1969 minor swing high, was exceeded to confirm the corrective low and make the trade successful if you place the stop below the blue line. So now you can see the advantage of placing your stop further away. It gives the trade some room for this market noise. If you place the stop below the red line, you would have been stopped out for a loss. If you placed it below the blue line, making it a higher capital exposure, higher risk trade, but a higher probability trade, the trade would have come out successful. So I want to show you a trade I actually took this morning. I recorded this webinar on May 20th, 2015, and this morning I was trading the US dollar Japanese yen cross. And while the rally off the May 20th low didn't quite have impulsive characteristics, the decline off the high at that time did have corrective characteristics. And let me add some bars here and show you that this market has been in pretty much a raging bull trend off the May 14th low. So any kind of minor corrective declines minor declines with corrective characteristics in a market with a raging bull trend like this, I try to take advantage of if the oscillators line up for me. So at this time, the 60-minute oscillator was bullish. And then I was looking to take a trade here in this 15-minute chart on another trailing one bar high trade strategy that I just described in the prior example. So the 860-minute DT oscillator made a bullish reversal. I placed a a stop to go high, one tick above the last completed 60-minute bar. And I was going to place a protective sell stop below the May 20th low. And long trade was triggered. Stop was placed below the May 20th low to give the trade some room. Because in my opinion, this is a very high probability trade setup here. This is a strong bull trend of the US dollar Japanese yen cross. If I would have placed it below the potential corrective low, it would have been stopped out right here. Once again, I mean, it was already stopped out, but this is some market noise here. So I'm looking for this rally above the May 20th high to confirm the correction off the May 20th high, and this was the high at that time. And then I had a rally confirming the corrective low. So I actually took this trade this morning. I tend to put my stops a little bit further to give room for some market noise, and this turned out to be a successful long trade setup here in the Japanese US dollar Japanese yen cross 15-minute chart. So should you always take high capital exposure trade setups? Not really. And let me explain why. So there are positive and negatives for both trade setups. Lower capital exposure trades usually come with lower probability, but higher profit potential. Higher capital exposure trades usually come with higher probability, but lower profit potential. Lower capital exposure trades usually come with many small losses, but the losses can easily be covered with a profit by one successful trade. Higher capital exposure usually comes with many profitable trades, but the losses can be very big. So you can see there's a give and take for both kind of trade setups. Only you can decide which trade setups are good for you. I call a person who should only take higher capital exposure, higher probability trade setups a type 1 traders, and traders who are able to trade lower capital exposure, lower probability trade setups are type 2 traders. While only you can decide which trade setups to take, I can help you determine if you are a type 1 or type 2 trader. By doing this, please check out my free ebook, 10 Questions to Determine What Type of Trader You Are, a prerequisite to becoming a successful trader. This ebook can be downloaded on my website at www.nobsforex.com, and the ebook is free, so check it out. Let's check out the position, the current position as of today of the Euro US dollar cross. So this video is being recorded the afternoon. It's actually 6 p.m. Eastern Standard Time, Wednesday, May 20th, 2015. And we're looking at the weekly chart of the Euro US dollar cross. Each bar here is a weekly bar. And as you may know, from the May 2014 high, the Euro US dollar cross has pretty much been in a raging bear trend. But as of the March low, we've had a bull trend. The big question of the Euro US dollar cross is this decline off the May high complete as of the March low, or is the rally off the March low corrective? As you can see, my analysis is loosely based on Elliott wave. If there's a potential Elliott wave count, I put it up. But I usually concentrate more on what we talked about earlier, the characteristics of trends and counter trends. And you can see the decline off the May high has impulsive characteristics, signaling the main trend has been bearish, which is pretty obvious. But like I said, the question is the rally off the March low impulsive or corrective? The bias, as far as I'm concerned, is the March low is a wave 3 of a 5-wave decline off the May high. If this is the case, a corrective high should be a wave 4 high, and then the bear trend off the May high should continue to below the March low before this strong bear trend off the May high is complete. With the 8 weekly DT oscillator bearish and the slow stochastic also bearish, and this past week's, and it's only Wednesday of this week, we've had a strong down week so far. It's a strong possibility this May high is a multi-week high, and the net trend will be sideways to down over the next few weeks. Question again, I'm going to repeat it. Is this May high, if it is a multi-week high, is it a corrective high, and should a multi-week decline eventually take out the March low? The May high is in the position to be the completion of an ABC corrective high. The initial signal that the May high is a corrective high would be a decline below this March high. and it still hasn't taken it out. And a further signal that a corrective high is complete would be a decline below the low of the week ending April 17th, which is pretty far from the market. Bottom line is, regardless if this is a corrective high or not, with the momentums, the oscillator is bearish. Very likely the net trend will be sideways to down over the next few weeks, and very likely the high of the week ending May 15th is a multi-week high. This is very strong information here. If you're an intermediate term trader, trade this market entering trades on the low degree time frame daily chart. I would only be oriented to the short side. Let's go down to the daily chart off this March low. So while there was a little high here above this March high, the bias is the March 18th high is a wave 1 or A high, April 13th a wave 2 or B low. Looks like we have a textbook 5-wave rally putting March 15th in the position to be a wave 5 of 3 or C high. And like I said before, very strong possibility it's a wave 5 of C high, meaning it's potentially a corrective high, and the result of a completion of a corrective high would be a decline to below the March 16th low. We have the decline off this May 15th high with impulsive characteristics, not corrective characteristics. This further signals very likely May 15th is a multi-week high. And then we've had a decline below the May 11th swing low. And this is a pretty major swing low, which is another strong signal that very likely May 15th is a multi-week high. However, we have our daily oscillators here, fast line in the oversold zone, slow line approaching the oversold zone. Very likely the immediate downside is limited before a multi-day low is complete. But if a multi-week high is complete, any multi-day rallies should only be corrections in a longer-term bear trend lasting several weeks, if not much longer, very likely eventually taking out the March 16th low. Can you see how useful this information is as far as which direction to trade, especially if you enter trades here in the daily chart? That doesn't mean you're going to be trading short in all time frames, but very likely the net trend, longer term trend, weekly trend is going to be bearish. Let's go down to the 240-minute chart. See, not much more information here except I put some strong support up, which is the 50% to 61.8% retracement support area of that 5-wave rally that I mentioned. And with the fast line of the 8 daily DT oscillator in the oversold zone, fast line of the slow stochastic in the oversold zone, their slow line just slightly above the oversold zone, very likely the immediate downside will be limited to this retracement support area before a multi-day low is complete. 13 240-minute DT oscillator is bullish. The slow stochastic is bullish. Very likely, though, the net trend will be sideways to up over the next several trading hours, but it's looking like this rally off the May 20th low has more corrective than impulsive characteristics. But short positions may not be considered in the low degree time frame 60-minute chart right now because the oscillators are bullish. Let's go down to the 60-minute chart to see what's going on. Unfortunately, there's not really a concrete wave count for the decline off the May 15th high, but in my opinion, it has more impulsive than corrective characteristics, meaning the high degree trend now is probably bearish, especially in the weekly chart, but it's probably bearish. The 860-minute DT oscillator is bearish, so short positions may be considered in the low degree time frame 15-minute chart, and you can see here that the rally off the May 20th low does have corrective characteristics, and I actually did take a short trade earlier today in the 15-minute chart to take advantage of a potential decline below the below today's low. I did not take the short position in the 60-minute time frame. 60-minute time frame was not my trade entry time frame because of the bullish 240-minute DT oscillator and the bullish slow stochastic. However, I took it in the low degree time frame 15-minute chart. I have my stop above this minor swing high at 1.1159 because if this swing high is exceeded, probably the short-term bear trend has turned bullish. So I have the stop above this 1.1159 swing high, and I'll take some profit if on at least part of my short position. I always trade multiple units. We didn't discuss that today. That's a whole different topic, but I suggest to always trade multiple units, and I will exit part of my short position, secure some profit on a part of my short positions, at least one unit, if not more. This is a 4-unit short trade that I took to secure some profit. Of course, if I don't get stopped out before, but very likely at least the May 20th low will be taken out, and potentially the decline will continue to at least this retracement support area. So not a bad short trade setup I took here. It's a short-term short trade setup, but it's in the direction of the higher degree bear trend right now off the May 15th high. So I hope you found this information useful about the current position of the Euro US dollar cross. Like I told you before, when you're watching this video, it's going to be way past April 20th, but you'll see if my analysis panned out. Well, that concludes today's NoBSForexTrading.com webinar. I hope you found the information very interesting and very useful. So what I'm going to do here, I mentioned earlier that I have a couple of services, a No BS Forex Daily Report and a No BS Forex Net Trend 100% video report. And for any attendees of this webinar, I'm going to give 1 month trial at a deep discount of only $19.95. The regular price is $69, so this is almost $50 off over a 70% discount. If you are interested in checking this out, please go to www.nobsforextrading.com/trial.html. This will take you to the page to purchase this $19.95 trial. And also at this page, you can also download my free ebook that I mentioned earlier in the webinar. Also, if you have any question whatsoever about this webinar or about my material, please do not hesitate to email me at jamie@nobsforextrading.com. Well, thank you for stopping by. I hope you found this information very useful. Have a great day. Jamie Johnson, over and out.